Welcome to Just Analysis. No bros, no BS, just analysis. This is the second video in the Ichimoku series, and this one is going over trade strategies. I'm going to go over the ones that are the most relevant, important ones that I use and that I implement in my own trading. There are others out there, but some of them I just think are real total crap. So the first one is the ideal Ichimoku strategy. This is a combination of aggressive and conservative. And so we're going to look for an example of a long trade setup. The first one is we're going to look for price to break above the cloud. We want the conversion line above the baseline, or the Tenkan-sen above the Kijun-sen. The lagging span above price, meaning it needs to be above the candlesticks. And the cloud ahead needs to be green. So I've done a market replay, which is basically I set the chart back to a certain time, and now I can just move it forward like it was live. And I'm looking for that long entry opportunity using these rules. So far, there are some signals that are saying, hey, you may have an opportunity to do this because the lagging span's above the candles and price is above the conversion line and baseline. The conversion line is above the baseline moving forward, but I'm not above the cloud yet. All right, now I am. Okay, everything here minus one thing is confirmed to go long. Price is above the cloud. The conversion line is greater than the baseline, and the lagging span is above the candlesticks, all right? What I don't have is A above B over here. I have to wait for it. There it is. Now I could go long, all right? There's one thing here that may make me go, I don't know if I really would do that. Maybe I would or wouldn't, because the lagging span is really near and close to the top of the cloud. That's a natural resistance area. This might be an area to wait, but otherwise, these are sufficient conditions to go long. Sometimes it's good to wait till the cloud breaks above the cloud, till the lagging span breaks above the cloud, but that is a long entry, and this is kind of the net result. By the way, I'm showing you past price action, and I'm cherry picking an example to prove a teaching point. So in reality, trading these kinds of things is a lot more difficult. Anybody who has attempted to trade probably knows that, but don't think of this example as something that is saying, oh my gosh, it's that easy. It's not. It's not. Learning these strategies is easy, but applying them to a real trading environment with real money, that's a totally different scenario. I'm going to be very realistic with you about that even though it looks simple and easy and it goes, oh my gosh, that's blah, 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 I can make a lot of money, blah, blah. You can lose a lot of money too. So just be aware of that. As far as a stop loss is concerned, there's a couple ways to do that, but I'm going to get into that a little later. Now let's look at an example of a short setup here using the ideal Ichimoku strategy. All right, so we're going to do the same thing, just looking for the short entry. So the short entry rules are price is below the cloud, the conversion line is below the baseline, the lagging span is below the candlesticks, and the cloud ahead is red. Span A needs to be below span B. So we're looking at this trade. We're doing Bitcoin again on the daily chart, and I see a lot of things here saying that we could eventually find a short opportunity because lagging spans below the cloud, price is about to go below the cloud, and the conversion line is below the baseline, but still we don't have that. See, look how the lagging span bounced right off of the top of the cloud. The cloud ahead is red, and so technically this is a short entry opportunity. We could have gone short back here, and you'll get into why I might have not done that, because in the ideal Ichimoku strategy, there's not a lot of checks and balances here. This is a combination of aggressive and conservative. But remember the principles of the Ichimoku system, okay? Price does not like to be far away from the Tenkan-sen or the Kijun-sen. I mean, it can expand a really, really long distance from the Kijun-sen, but as far as the distance between the conversion line and price, they don't like to move very far away from one another. And so that's something to pay attention to. So as we're moving on here, we got back in the cloud, would have got stopped out maybe. But here, anytime around there, that was another opportunity for an entry. The conversion line's equal with the baseline, but moving lower. Span A is below span B in the future. Lagging spans below the candlesticks. Prices below the cloud. All good examples of a short opportunity using the ideal Ichimoku strategy. The next strategy here is probably the one I use the most. It's the most fun, I think. I mean, I day trade a lot, and this is the one I think is the most useful. Manesh Patel said that this one represents the highest risk, and he said that there's a lot of opportunity for entry. This is definitely the most aggressive out of all of them, because you'll notice a lot of the conservative Ichimoku strategies involve the cloud being the area that price needs to move above, and that we generally view price above the cloud as being in a bullish trend, and price below the cloud is in a bearish trend. Well, this K-Cross strategy stands for Kijun-Cross. This is kind of the bread and butter day trading strategy within Ichimoku. So for a long setup, what we look for is price to be above the baseline, and we want the conversion above the baseline, but if it isn't, then the baseline should be flat and the conversion line should be sloping up. And let's see, we also have the lagging span should be an open space, meaning it's above the candles. Span B should be flat or pointing up. Span A, this seems like a lot of rules, but I mean, after a while, you're just going to kind of be able to glance at it and go, oh, okay, this is okay to do. This isn't okay to do. Span A should be above B, but if it isn't, then span A should be sloping up. And then all of the price conversion line, baseline, and lagging span, they shouldn't be in the cloud. But if they are in a cloud, it should be a thick cloud. And also, we don't want price to be far away from either the baseline or the conversion line. And then an optional condition is that the cloud that we're in is not thick. Okay, it seems like a little contradictory with the number 6 rule and the eighth optional, but they're pretty complementary. Okay, so as an example, we're looking at Bitcoin's chart again. So looking at the chart here, we're moving forward, and what's happening? I see Bitcoin cross above the Kijun-sen, all right? But nothing else here is saying that it's okay to take a long. We have a few more conditions that need to be met. Okay, we have 2 more conditions met. Those are, we want the conversion line above the baseline, but if it's not, we want this happening. We want the conversion line to be pointing up, and we also want single span A to be pointing up. So span B is flat, span A is pointing up. That's good. Those are all good signs. And we're continuing on here. Continue to move. The last condition we're really waiting for in all of this is for the lagging span to be above the candlesticks. And once that occurs, then we should be good to go. Lagging span is now above the candles. However, what is not happening? Senko span A is not below. Single span A is not above single span B, and it's not sloping up, so it's not ready yet. Now we have to wait for single span A to slope higher, which it does on the next candle, and now all of the conditions in the K-Cross strategy are met and valid for entry. Price is above the Kijun-sen, conversion line's above the baseline, span A is below span B, but span A is sloping up, and the lagging span is above the candlesticks. So that there is a valid entry. And you can see it took a few days for it to, more than a few days, like a week or so before it started to move in the direction that we wanted it to go. Now let's look for an example of the short side of the trade here with the K-Cross strategy. So for the short side of the trade, if we're going to take a short, we're just looking for the inverse of what we had long. Price needs to be below the baseline, conversion line below the baseline, or the conversion line can be above it but needs to be sloping lower. Lagging span needs to be in open space or below the candles. Span B is flat or pointing down. Preferably span A is above B, but if it's not, then span B is flat and span A is sloping lower. And then we don't want the baseline, conversion line, price, or the lagging span in a cloud. But if they are, it should be a thick cloud. And then we don't want price far from the conversion line or baseline. So that's normal. Okay, now moving forward. So we're looking at Matic. This is Matic on the hourly chart. And if we move forward, we're looking for an example to short here based on the K-Cross strategy. So what do we have? Price is below the baseline, okay? But we don't have, and the lagging span's below the candlesticks, but we don't have a red future cloud, and Kinko span A is not sloping down. So we need to wait. So we move forward another period, moving forward some more. Now we have a level to look at. Okay. So this is the hourly chart. The lagging span is below the candlesticks. Price is not yet below the Kijun-Sen, okay? It just closed a hair above it. But everything else that we would need in order to go short is present. Conversion line sloping down. Span A is sloping down. We just need price to close below the baseline, and then that should fulfill our conditions for entry, which it does. Is price below the baseline? Yes. Is the conversion line less than the baseline? No. But if it isn't, is the conversion line pointing down? Yes, it's sloping down. Is the lagging span below the candlesticks? Yes. Is span B flat or pointing down? Nope, it's not flat or pointing down, but span A is sloping down, so that's good. Price, conversion line, and baseline, are they inside a thick cloud? I don't know. I'd say that's maybe thick. I mean, medium. I don't know. It's not enough for me to go, no, don't take it. And then the optional is not in a thick cloud. Again, it's kind of a medium thickness cloud. By the way, thickness of cloud, that is totally subjective. Like most Japanese analysis, there's a lot of subjectivity involved. So let's say we took that short. What would have happened? A lot of choppy price action. You're going to see that a lot. And then you just kind of see it move and do its thing. All right. Again, this is just a cherry-picked example, not indicative of real world trading environment. So this third strategy is called the Kumo cloud break. Manesh Patel said that this is his least favorite, and I can tell why. It's also the most conservative, and it's really exact same thing as the ideal Ichimoku break, with the exception that the lagging span needs to be above the cloud for a bullish entry and below the cloud for a bearish entry. So again, when we look at this chart here, I've done another market replay. This is gold's daily chart. In order to go long, we need to have price above the cloud. The conversion line needs to be below the baseline, and really just the same conditions over and over and over. This is the third one. If you can't figure out what all these are, then you don't need me to repeat them all over again. So we're just going to click, looking at, oh my gosh, look at what gold is doing. It's consolidating. It looks like it's about ready to break out. Oh my gosh. Okay, so what do we have going on here? I mean, I don't even know if I would have caught this one, but technically the lagging span is below the cloud, and technically this would fulfill an entry. All right, price is above the cloud, conversions above the base, Kinko span A is sloping up, and the lagging span is above the cloud. I don't think it's most ideal area, so you could look at the next entry. That's what we'd be looking at, an entry right there, and that is what happened. All right. Again, Patel said that this one is his least favorite, and here's the deal: this is not one of my favorites either, because they tend to have limited upside potential at times depending on the market. You know, trading, especially day trading, is about risk, and risk should have reward. And there's not a whole ton of risk involved with this strategy, although there still is. It's just compared to the other two that we've done, it's not. It's a lot more conservative. So let's look at an example of a bearish cloud break. So looking at the short side of the trade using the Kumo cloud break. So we want price below the cloud, conversion line below the baseline, lagging span and open space, just the inverse of what we looked at. So let's take a peek at what we've got going on here. And the market's moving. And we're looking for that short entry. And okay, so here technically is a valid short. Why? Span A is not, or the future cloud is not red, but span B is flat and span A is sloping down. We have the conversion line. I don't know, is the conversion line, it is barely below the Kijun-Sen. So the baseline's below the conversion line's below the baseline. Lagging span is below the candlesticks, and it's an open space, and it's below the cloud, and price is below the cloud. So everything here says that it would be okay to initiate a short trade. And that's the resulting price action. Again, I cherry pick these because they're good examples, but it is not indicative of any real world trading results. All right, so that's the Kumo cloud break. Now, the problem with any of these strategies is this, and we're going to get into that right now. So some of the problems with the Ichimoku system is that, it's hard to, there is no in trading system confirmation tools outside of just the system itself. So here's something that I like to look at when I am using the Ichimoku system. First off, you should have multiple time frames, all right? And I like to use, depending on how I'm trading, if I'm going to trade on the hourly chart, I like to have the hourly chart as my primary entry and trade time frame. And then I'll have the 4-hour chart, which is going to be on the top right. And then the daily chart, which is on the top left. I kind of let the daily chart dictate my trade direction as far as how does it look on the chart. I mean, if I look at this chart, am I looking at a bullish or a bearish looking chart? I'm looking at it's definitely leaning bullish. I see some consolidation going on. Prices above the Kijun-Sen and the Tenkan-Sen, and ultimately we're above the cloud, all right? And I like how close it is to the Tenkan-Sen and the Kijun-Sen, meaning any type of breakout is likely to be a nice sustained one on the hourly. And then look at the 4-hour chart, and I just kind of look at, is there any medium-term resistance or support? There's not. Actually, I should not look at silver's chart. I should look at, let's look at the US dollar, Canadian dollar. Okay. US dollar, Canadian dollar. On the daily chart, it actually does fulfill the criteria for a long entry based on the K-Cross strategy. Why is that? If you remember, Senko span B is flat, but span A is pointing up. The conversion line is below the baseline, but it's pointing up. And the lagging span is above the candlesticks. But here's the deal. Like, I really could not go long here unless there was a close around 2165, 121.65. But that's fine. All I know is that there's definitely a momentum change here that is pointing to some at least temporary, violent, short-term upside pressure. Okay? On the 4-hour chart, what do I see happening? I see that we've had a nice breakout and that we're coming down to some support levels in the Ichimoku system on the 4-hour chart. So the Tenkan-Sen and the Kijun-Sen are the near-term support. Now I take a look here at the US dollar, Canadian dollar on the hourly chart. My trading direction I've determined is long, so I'm only going to take long trade setups. And now you have to kind of do a little bit of planning ahead here, okay? So no matter what strategy I was going to use, the lagging span is generally going to be the thing that is the final trigger, all right? And the lagging span in any of these strategies, it needs to be above the candlesticks. So unless over the next, 1, 2, 3, 4 hours, it moves back up to 121.65 or so, actually a little higher, 121.71, I'm probably not looking to go long yet, okay? Really probably not looking to go long until it breaks that. So, or it could trade sideways, but that's what I'm looking at. I'm not looking to go short, but I am looking to go long if those conditions change. Some tools that I like to use with my Ichimoku charts, for example, let's look at a K-Cross strategy. Let's look at it like on the pound dollar. Is there a good example of a short here? Let's see. Okay, so here's a good example. The Australian dollar, US dollar on the hourly chart, this is definitely one that I would be looking to short, okay? But how do I know that if I take a short entry at some point, it's going to, continue south, or is it going to move up? That's where I think, there's a whole suite of oscillators, folks, but the ones that I like to use are the RSI, the composite index, and the percent B. But if you're unfamiliar with the composite index, that's fine. Connie Brown developed this. It's a trademarked indicator of hers. It's really just the RSI with a momentum indicator. But one thing that you should know is that the RSI, when something shifts into a bear market, the oversold conditions change. The oversold conditions in a bear market are 55 and 65. So when I look at this chart, this is a combination of using oscillators, the Ichimoku system, and candlestick analysis. I know that this candlestick right here so far is an inherently bearish one. In about 1 minute and 46 seconds, it's going to tell us what kind of candle it will be. Is the volume appropriate? Oh, freaking loop. Absolutely, yes, it is. It is very appropriate. I see that the RSI is stalling out up against the level 55. There's also some regular bearish divergence that exists. Wait, is there? No, there's not. But regardless, it's facing some pressure up here against 55. And then I see the composite index has actually dropped below its fast average. And most importantly, it looks like the percent B oscillator is about to cross below 0.8. All of those things tell me that, at least temporarily, any further upside potential should be limited. Additionally, normal traditional Western price action tells me that we are looking at a bearish continuation pattern known as a bear flag. And so my entry, based on this setup here, what I would be looking at, and you could do this one of two ways. You could be conservative and wait for price to get down to, the lagging span would need to be an open space, so we would need it to be back down to 76.94. Or we could wait for the candlestick close and initiate the short once it moves below the Kijun-Sen and Tenkan-Sen. So you could look at a short at 77.10. And I'm just going to put a little line there, 77.10, roughly around there. So if the Aussie dollar, US dollar, pierces this level, that may be a zone I'd be looking at to short. And that's using a combination of confirmation indicators along with the Ichimoku system. And we'll come back to see how this went if we would have shorted that. This is on the live market, by the way. I paused it and then unpaused the recording. Okay, so question here is, where's my stop loss and where's my profit target? Well, because we're using multiple time frame analysis and you were looking at an area to short here on the hourly, I want to identify some future support levels that exist on the higher time frames. So on the daily chart, do I see any near-term support levels? I don't. I really don't see any near-term support levels. Let's go one time frame higher. The weekly chart. Do I see any near-term support levels on the weekly chart? The only one that exists on the weekly chart for support below price right now is the top of the cloud at 73 even. So it's more than 400 pips below where we're at. But more than likely, I think you'd want to look at the support level that's back here around 76.01. So roughly 100 pips below. I don't want to get much more into the strategy side of things because the third video is going to talk about the confirmation tools that can be used and some ideas from the other Ichimoku authors, specifically the most recent one, Kunitz's book. I want to go over some of his ideas on how to help confirm, because he also brings up a really good point about something that felt very validating to me, was that there's a huge open space of trade opportunity that is totally ignored in the Ichimoku system, and that is the time between one cloud to the next, because most of the trade strategies involve the cloud being the triggering area of support or resistance that must break before a trade entry is taken, and it's also the place that we we are supposed to totally avoid. Something I still practice, but nonetheless, I mean, this is a newer approach, and I think it will demands some look and study at. And so, yeah, anyways, the third video, we're going to talk about tools to use in conjunction with Ichimoku to help make it like your own and to help make it more effective. Thank you guys for watching. And don't forget to like and subscribe.